Hello and welcome to this weekly market report for the week ending November 22nd. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. It's a pleasure to be with you again this weekend. Quite an interesting week for sure. Starting off with economic reports, we had some pretty good reports coming out in the housing area. Housing starts, building permits, existing home sales all came in above expectations. We got a pretty decent initial jobless claims report on Thursday, where we came in about 6,000 below expectations. So I think that shows us that the economy continues to hum along between initial jobless claims and what we saw out of the housing area. Interest rates kind of flattened out, kind of maybe rolled over a little bit. I think on their chart, looks like maybe we might see a little pullback in the 10-year Treasury yield. I wouldn't be surprised maybe to see us move back down to the 410, 420 area. We finished the week just a little bit above 4.40. So I wouldn't be surprised to see us maybe drop a little bit there in the coming week or two. There is a negative divergence on the daily chart. That's primarily what I'm looking at there. From an earnings perspective, we had some big surprises to the upside, had a couple of disappointments to the downside. I thought Snowflake, SNOW, really big report there, huge gap up. Williams-Sonoma also had a nice report, gapped up. And Walmart came through with a really nice report and showed broke to another new high. On the flip side, Target numbers fell a little bit short, and that was not good. The stock took a pretty big hit. But all in all, I thought the earnings were okay. We kind of moved beyond a lot of the really big earnings reports. I mentioned those that I mentioned were some of the biggest reports out this past week. But yeah, I mean, I think the market took it all in stride. We bounced off some key moving averages. So let's go ahead and look at the action and see exactly where we finished the week. So I'll start off here with the Dow Jones Industrial Average. This is a daily chart. So in order to get the weekly, we have to go back and look at 5 of these candles. But you can see we had broken out to all-time high territory on the Dow. And then over the course of probably toward the end of the second week of November into the third week, you can see we had pulled back, went all the way down to that 20-day moving average, got close to gap support, and then for the balance of the week since about Tuesday, really nice recovery in the Dow and across most of our major indices, but really a lot of strength in the Dow, a lot of strength in the small caps, mid caps. Banks had a really good week, industrials bouncing back. All in all, I thought it was an excellent week for the market and about what we expected at earnings beats. Let's take a look at the S&P 500. Pretty much the same thing, moving back down to gap support right at that 20-day moving average. We did see a nice recovery into the end of the week, but unlike the Dow, which actually closed at its highest level on Friday, closed at its highest level ever by 3 points, not by a lot, but we'll take what we can get. S&P 500 actually fell a little bit shy of its all-time high. Still got some work to do, still below the 6,000 level. Remember, we had that one close, I think it was at 6,001. But that's a psychological level, big round number like that. I think we saw a lot of selling coming as a result. But bouncing off the 20-day, I think next week we see a new high on the S&P 500. We'll see. One thing that I put on this chart over here, this is the annual or the annualized returns for each day, each calendar day for about the next 2.5 weeks. And what I see when I look through here, now keep in mind the S&P 500 has gone up on an average 9% per year since 1950. So if every trading day was equal, what I would expect is that the average annualized return or the annualized return of each day would be about 9%. But notice November 21st through the 18th. Now, the 21st was Thursday. That's when we expect, at least from a historical perspective, things to start turning around. That's exactly what we saw Thursday and Friday. Very, very strong action. I did a video over at Stock Charts on Wednesday evening that was published, I think, on Thursday. And I talked about the expectation of small caps jumping into the end of the week. And really, I think they're starting a really big move that could extend for quite a while. And we saw that Thursday, Friday, we saw small caps really rip to the upside. But looking at these annualized returns, this is on the S&P 500. So just over the course of the next 2.5 weeks, some of these days, 54% was the 21st, which was Thursday. But then we get next, actually over the weekend, unfortunately, We don't have the 23rd and the 24th this year because they fall on Saturday and Sunday. But I look at these in total and just kind of look at the period. So 23rd and 24th, 50%, 125% gains, average or annualized returns. November 25th, this is next week, 25th through the 29th. Of course, 28th is Thursday. That's Thanksgiving, so we won't have to worry about that day either. But this whole upcoming week, 33%, 56%, 52%, 31%, and 5%. Except for Friday, every one of these other days, we tend to see very, very strong action, much better than a normal S&P 500 day, given the average return of 9% since 1950. But then when we go past, Thanksgiving and start December, you get past Friday, and then on the 30th and the 1st of December, you got 20%, 15%, and then into the following week beyond Thanksgiving, 21%, down 37%. So that we don't see too many down days this time of the year. But anyway, down 37%. But then after that, up 34, up 36, up 44, up 22, up 17. All these numbers well above that 9% threshold. So I just look at over the next 2 to 3 months, or excuse me, 2 to 3 weeks. And we talked about this at the end of October. We are in the most bullish time period of the year. October 27th at the close through January 18th at the close. No other time period of that extent, of that length, compares to this period that we're in right now. So it's really hard for me to get bearish when I know that the S&P 500 has gone up 62 of the last, or actually 63 of the last 74 years from October 27th to January 18th. 63 out of 74 years, if you just slept for 2 months and 20 days, you would wake up with a higher S&P 500 than when you went to sleep and hibernated throughout the winter, or maybe late fall, early winter. Anyway, just wanted to pass along those numbers. NASDAQ 100 made the breakout. You can see back in early November, pulled back, went a little bit below the 20, a little bit below gap support, been a little bit slower to rebound. So I think you can just look at this chart and see that maybe there's just a little bit of, I don't know, maybe a little underperformance relative to some of the other indices. I think that's pretty evident when you see the Dow breaking out and the NASDAQ still, where did we finish? 2776, and we got to get up near 21.2. I mean, we're probably still a couple percentage points below our all-time high. And that's not the case on the Dow, which is already breaking out, or the Russell 2000, which is right up against its a breakout level. Speaking of the Russell 2000, here we go. Here are those last few days. I mean, really off the Tuesday low, we have seen a monster explosion to the upside here in the small caps. I mean, we were down to 227. We rallied $12 from the early Tuesday low to the Friday close. So that was probably at about, I don't know, somewhere in the $12, got to be about 4 or 5%. Pretty big move for over the course of 4 or 5 days, or 4 days. So anyway, IWM, I think, looks really good heading into next week. Mid caps, pretty much the same thing, except mid caps made the breakout. We actually got a breakout on the mid caps. Very strong week there. And transport's going down to the 20-day moving average, bouncing right off. So all of our major indices, when you've got PPOs rising and pointing higher at the most recent highs, I tend to look at 20-day EMAs as your key support level. And essentially, that's where we held on our major indices early last week when we had the weakness. And then we came in really strong toward the end of the week. I think this sets us up for a strong finish in November. Looking at the sectors, good news, all 11 sectors higher. I remember when we were rallying, in the past, and there were a lot of folks saying, well, the breadth is awful. Well, you don't hear anybody talking about the breadth. Now that we have breadth, people are talking about, well, it's not sustainable because now we don't have the leaders. We don't have the Mag 7 doing well. I mean, make up your mind. Can't be both. I mean, something's got to lead and something's got to lag for a while. For me, it's just bullish rotation. So, I mean, if you look at any, and when I look at this chart, I see materials, utilities, energy, real estate, and then staples are in the 6th spot. 5 of the top 6 areas are areas we really don't want to see leading, right? Well, it's okay for them to lead once in a while. I mean, if you look at a long-term relative chart of all of these various sectors versus the S&P 500, we're getting strength exactly where we need it. Now, if this were to continue for the next month or two, if we have a whole month of this and we're breaking out, sometime in late December, early January, we're still seeing a lot of relative strength in these 4 or 5 groups that I'm pointing out, that wouldn't be good. I mean, we want to at least see some of the aggressive groups moving, and leading to the upside, whether it's the industrials or consumer discretionary or technology, whatever. We do want to see this flip, but I'm not going to get upset over 5 days. In fact, I like the bullish rotation. I like to see wide participation, and that's exactly what we're seeing. And you can see that pretty clearly here on the chart. All right, I want to mention healthcare. Now, if you go back and look at sector performance, healthcare was last. So it's like, why do you want to mention healthcare? Well, healthcare is getting close to an area where I think we're going to see a big reversal. Maybe we already did. But if you go back and you look, this is a chart. We were going up. We consolidated sideways for a while. Nothing wrong with that. We had a double top in at about 137, unable really to get through it. But if you look at the low between the tops, this is your key support. Did we ever violate that? No. So what I'm looking at is a move to the upside, sideways consolidation, and a breakout. Now, that prior 2 years of going sideways, we had a clear resistance level, and now we have a clear support level. When you break above resistance, it creates support. Support now is at that 137 level. We've seen it tested back in early 2024. We saw it again in early April of 2024. And with this weakness, we got down pretty close. This was earlier this week. We got down as low as 140.26. We were only $3 away from that support level. Meanwhile, our high was up at near 160, probably 159. So at the low, we were $19 away from the high and only $3 away from the low. So it was starting to set up as a much, much better reward to risk trade in the healthcare area. And I found these next couple charts to be pretty interesting. So here's healthcare on a seasonality chart relative to the S&P. So what it's doing is over the last 5 years, that's the default, is 5 years. But it's saying that December, we haven't had December this year, so really only 4 years. 3 of the last 4 years, healthcare has outperformed the S&P 500 in the month of December, and by an average of 2.2%, which is better than any other month of the year. But that's only the last 5 years. And look at November. It's the only month where healthcare has not been able to outperform. November tends to be a pretty bullish month. It's one of the best months in the year. We got over the last 10, 20 years, it's been mostly July's been strong, April's been strong, November's been strong. I mean, those have really been the 3 biggest months for the market. But you can see healthcare not really enjoying November, at least over the last handful of years. Now let's drag it back to 12 years. So this is going all the way back to 2013 when we first confirmed this secular bull market. Since that time, December has an average outperformance for healthcare of 0.7% during the entire bull market, or at least since it was confirmed in 2013. But over the last, so it only beats by, roughly half, just under half of the months of December. So out of the last 12 years, I don't know, actually we haven't had December, so it would be out of the last 11 years. So that would be 5 out of 11 years it's outperformed, 6 it's underperformed, but the average outperformance has been positive at 0.7. And if you look across the bottom here, that's the best average outperformance of any month during the year for healthcare. So we've got the price action, which has been dipping back down close to support. And then we've got action that kind of tells us that this might not be such a bad time to be getting into healthcare as well. If I drag it back 20 years, December at 0.7 is second only to June at 0.8 in terms of relative outperformance. So you got June, then you got December, and after December, the next best month is January. So you got December and January coming up. So I just want to point it out because we get a lot of us use or have recency bias, and you look and you see healthcare not performing well and you just toss it out. Just keep in mind, next couple months historically haven't been bad for healthcare. The other chart I wanted to show you, this is small cap healthcare ETF, the PSCH. It's one of the Invesco small cap funds. So the PSCH, small cap healthcare, versus the XLV, which is large cap healthcare. And look at what has happened here over the course of the last month and like 5 weeks. I mean, we have gone from the 52-week low to the 52-week high. I mean, it has just been straight up. And this is signaling a lot of what's been going on in small caps. Small caps have really been crushing the S&P 500. And remember that when you're looking at small caps, you're getting a lot of small caps that aren't making money. So you got to zero in on the leaders in these small caps. It's not any small cap stock that you can just jump into. But I think if you look at the leaders, you can do extremely well when small caps start to lead. I said back at the beginning of 2024 in January that this was going to be the year of the small cap. I thought it would have happened earlier than it did. I mean, we started to see an explosion back in July when we had the June CPI report. Remember that came out around, I think it was July 11th. And we saw small caps just absolutely explode to the upside. And then, of course, the Fed came along and said, no, we're not quite ready to lower rates, even though the market was poised and ready to go. And so we pulled back one more time. And now the Fed has not only said that they were switching and going to lower rates, but they've actually started to do that. And as a result, we are seeing the small caps exactly like I said it would happen. Small caps are exploding. And when they explode, they're kind of like semiconductors. They don't just explode for a little while. When they get going, they get going. And you look at some of the stocks, and you're like, oh, this one went from 7 to 15. It's way overbought. I can't buy it. Next month, you look at it, and it's at 27. And then it's at 40. These stocks can move, and they can move extremely fast. And the reason is, first of all the money's been rotating outside of small caps. So there's a lot of money that will rotate in and drive prices up. But there are fundamental reasons. And I talked about this in Market Vision 2024 back in early January. I said, when rates start coming back down, when the Fed funds rate starts coming back down, what you are going to see is that spread is going to enable many of the small and mid caps bank stocks to do extremely well. That's just profit dropping to their bottom line. And then what happens is when they start making more money, they lend more. What does that mean? Well, they have a lot of small and mid cap companies that are their customers. So if they're free to lend more, other small cap companies and mid cap companies are then have more credit available to grow their business. So it's like, a snowball coming down the mountain. So the lower Fed funds rates, as we keep lowering rates, is putting money in these banks' pockets. And then they're able to lend at higher rates versus what they can borrow from. They can borrow from the Federal Reserve at the Fed funds rate as it comes down. So it is literally just putting money on their bottom line. That opens up capital. There's capital available for other companies, small, mid-cap companies that need to borrow in order to grow their business, makes them much more competitive. And all of a sudden, their earnings start to grow. And then what happens to their multiples? Multiples start to expand. So we've had 3 years of, don't even want to say it, but it's not been good for small caps and mid caps relative to the Mag 7. Small caps are getting their due now. Yeah, you don't want to ignore this group. All right, one of the things we do when we look at, we see an area like this, healthcare, or it doesn't have to be healthcare. I'm seeing small caps everywhere going up. But just to give you an example, we have our strong earnings chart list, which gives us fundamental, stocks that are doing very well fundamentally. Also look pretty decent technically. That's how they get onto this chart. They're liquid. They have to have all three in order to meet the filter requirement to go on our strong earnings chart list. But at stock charts, once you get them on a chart list, you can then pull this up in summary form and you can type in what you want to filter the entire list by. So I type in healthcare and look at this list I get. It's giving me all the healthcare stocks on the strong earnings chart list. And what I did is I sorted it by market cap. So this is $590 million company. All the way down at the bottom is a $543 billion with a B dollar company. So you can look at some of these small caps and see, what's been going on. I see a lot of green. This is just for just the last week. But you can see like BLFS. So BLFS, after the big downtrend, you can actually see put in a hammer, come roaring back in 4 days off of that. We could go, let's see what else is on here. WGS is a favorite stock of mine in the medical equipment area. WGS, big earnings report. Look at that gap up. Look at the volume coming in on this move. So the stock opened around 65, went up to 85. And so when I added this, we put these little annotations in here. And to me, gap support are the two key areas to watch. Where did WGS just come down to about 4 days ago? Right down to $65. And where did it close at on Friday? 78.71. So if you're watching the annotations on the chart and you happen to jump in around 65, expecting that that's where we could see a nice reversal, that would have been a quick little 20% from 65 to 78 in 4 days. So this is, some of what you need to be looking at. Let me see, there was another one down here. Yeah, MDGL, 20% last week. Look at this one. Where did it come down to? Here was the big move. There's your gap support. We went from 275 to 370. And I annotated and put this level in here at 275. Now, probably when it was up at 360, 370, most folks were thinking, okay, there's no way it's going back to 275. 6 days later, it hit 275. And what happened if you'd have had an order in at 275? Well, since then, it's been a week, and we're back to 350. 350. That's almost 30% on this stock in a week. That's how fast these stocks move. So you got to get on board. Here's a raised guidance chart list. So we keep a list of all the stocks that show raised guidance. And again, I put this in order of market cap. So you can go right down the list and see. I mean, this is over the last week, right? Or no, that's actually over the last day. So let's pull up the last week. And you can see ATEC up 22%. That's one of the better ones. But I mean, here's one down 5%. But if you look at many of these, 6%, 9%, 5, 4, 2, 3, 9, 15, 3, 5, 6, 11, another 10. Very few are down. These small cap stocks are absolutely catching fire where a rising boat is lifting, or rising tide lifting all boats, not a rising boat lifting all tides. That doesn't make sense. Also, the IWM relative to the S&P 500. The last time we had a good run on small caps was when we went through the pandemic. And what'd they do? Lowered rates. Fed funds rates went down to 0.25. And right after that, what did small caps do? Small caps absolutely crushed the S&P 500. Folks, this is what we're looking at so far. This is just starting. If I'm right, we're going to see this IWM absolutely soar relative to the S&P 500. And I don't know how long it's going to last. Maybe it's 6 months. Maybe it's a year. IWM closed today at 239 or thereabouts. I see it going to 300 minimum. I mean, that's another 25% from where it is right now. I mean, that's just what I think could happen in the next 3 months. I mean, we might be at 400 sometime in 2025. Like I said, when these move, you can see, look at that relative strength. Looks like almost like a semiconductor chart. These small caps explode, and I think they're just getting started. Now, what I did here is I just put some of the small cap ETFs onto this chart with the IWM as a benchmark. And one thing I was seeing is the small cap energy names and small cap materials doing very well, moving into a leading quadrant relative to the IWM. So this is some areas maybe to consider. Here is the consumer staples area. A lot of the small staples starting to move more in northeasterly fashion. That's really what you want to look for. Discretionary and healthcare right now, small caps, again, the PSCH relative to the XLV is doing well, but remember, the XLV has not been doing well. the PSCH relative to the IWM is doing very well. So it doesn't look as strong here. And so what I was showing you with healthcare, they could have been some of the laggards in small caps. I mean, if I went back and pulled up energy or materials or any of these other sectors, I'm sure we had some other stocks, maybe even better. And I didn't add PSCF. One I forgot. PSCF. Let's add that one in here and see where that is. Oh, look at PSCF. That's right in there with energy and materials. A lot of the small cap financial names doing incredibly well. So I talked about the banks and the fact that the banks tend to do really well when, small and mid-size, when you've got short-term rates coming down and the long-term 10-year treasury yield remaining high, because all of a sudden that inverted yield curve uninverts. And when that uninverts, it's a cash flow, bonanza for small banks. And so as a result, I think you're going to see the small caps do very well, but also specifically, I think banks are going to do well. I talked about it again, market vision beginning of the year. I thought banks, especially small banks, would do extremely well when the Fed started cutting the Fed funds rate. Here was that July. Remember when the June CPI came out? Market started to expect rate cuts. What happened? The KRE took off. And then the end of the month, we had the Fed meeting. And of course, the Fed does what it likes to do, which is disappoint. They said at that time that a rate cut was on the table, but they didn't say they were going to cut rates. Then the minutes came out 2 weeks later and talked about the fact that many of the folks on the committee, the FOMC, were in favor of cutting rates. So stuff that wasn't mentioned in the policy statement, I'm not going to get started because I really not very excited. I don't trust this Fed as much as I've trust previous Feds. I think Yellen and Bernanke were much, much more transparent than what Powell has been. But I also think Powell was dealt a pretty tough hand with the pandemic. So we'll balance it out. Anyway, now that rate cuts are definitely in, though, look at what happened from the low here in early September. We started to make a big move. We've rallied up. The IWM's, gone to an all-time high. The smaller banks, the KRE is the S&P Regional Banking ETF. And so we had the big gap up early November. We pulled back a little bit. We just set another new high today on Friday. So keep the KRE in mind too. I think this is a really solid investment. I have to tell you, I'm not a registered investment advisor. I always like to point this out. I am not recommending. I am not advising. I don't do that because I'm not licensed to do that. I educate. That's all I'm on here for. I just want to educate folks, to teach people based on signals how you can outperform the S&P 500. But you almost have to have small caps right now to be doing it, and banks. So what's not been working? Well, Apple's in a nice pattern, but it's been going sideways. It's not taking off. How about Microsoft? No, it's actually downtrending, not looking very good. How about NVDA? Well, we went sideways. This is probably one of the better Mag 7 stocks, and it's certainly a leader in the semiconductor area. They reported decent numbers, beat on the bottom line easily. But I don't know if it was good enough. I mean, we gapped up, we set a new all-time high, but we reversed off of it that day of earnings and went back down again on Friday. So I think we're just consolidating. I think there's nothing wrong with NVIDIA. I just think since semiconductors topped back in June, that's not really where the money's been rolling toward. It's been rolling more toward the small caps, toward the banks, the financials, the industrials. That's where we've been seeing that leadership. How about Meta? Meta topped. I love Meta, but it's been hovering down here. I think somewhere around this 540 area, probably be a good entry point. I don't think Meta's dead. It's just sitting on the sidelines while money rotates elsewhere. How about Amazon? I love Amazon's breakout recently to a new all-time high, and I thought this 200 level would hold. 20-day test, come back down. That was the price support level, but we went a little bit through that. Maybe we go back down, test some of these gaps. I mean, 195, there's gap support. The lower end of gap support's probably around 187. Got the 50-day in between both of those. So I don't know, maybe that's where we turn around. I mean, I think these are great investments long term. I just don't, they're not in favor right now. Google, I mean, again, topped back in July. The problem is there's still a lot of traders still looking for these stocks to go. Mag 7. It's not where the money's going right now. I think beginning of the year in the first quarter, I think these stocks will pick back up again. I think small caps continue to do extremely well as also, but I do think that this is going to be one of those situations where a rising tide lifts all boats. I wanted to point a couple things out here because, I don't think we're all talk at Earnings Beats. You can see in our last portfolio quarter, and we update our portfolios every quarter, we put in 10 equal weighted stocks, and we just compare how we do relative to the S&P 500. Well, in the August 19th to November 19th time period, our aggressive portfolio, which is made up of small and mid-cap stocks, went up 25, almost 26%. During the exact same period, the S&P was up less than 5%. So we more than quintupled the return on the S&P 500 in our aggressive. And in our model portfolio, we more than 4 times, more than quadrupled it last quarter as a result of the small and mid-cap stocks doing much, much better. They certainly helped our portfolios, and that was the theme going in. We expected it, and we got it. I don't think it's stopping. I think small caps are still going to continue to do very well with short-term rates coming down and the longer-term rates. I think longer-term rates can come down a little bit. I think short-term rates will be coming down faster, and I think that's going to play right into the hands of the banks, many of the small-cap companies, mid-cap companies. I think that this is just starting to the upside. I do want to mention also, if you go over to our website at earningsbeats.com, you can scroll down. Anyone who signs up for our free newsletter, we're going to send you immediately one of the small cap stocks that I really like. And if you want to check out our service, I mean, I've handed out probably 30 small cap stocks to our members recently through our portfolios and through a video I did last weekend. I gave a perfect chart explaining why I thought banks are going to do well why the small caps are going to outperform. And in doing that, I also provided 10 stocks. And I think I have somewhere around here. Let's see if I can find them. Yeah, here they are. So of the 10 stocks that I provided 1 week ago, I'm going to tell you that, let's see, the stock I'm going to send you tomorrow, or as soon as you sign up for the EB Digest, we'll send you this stock that has gone up 10% this past week, but I think it's just getting started. The next stock on the list of 10 is up roughly about 8%. The next one on the list is up probably about 7%. The next one on the list is up probably about 6%. The next one is up 9%. The next one is flat. The next one is up 17% this week. Next one, this one's actually down 3%, probably setting up nicely, to be honest. The next one is up 15%. And then the last one is up about 5%, and they're getting ready to report earnings, and I think they're going to be big. Anyhow, if you sign up for our service, our regular service, and we're just starting our fall special, so you can get 20% off. You click on that link right there, and it'll take you right into our fall special. Normally you can see that our normal rate's $997 a year. Our normal monthly rate's $147 a month. So times 18 months, that's like $1,700. You don't want to be in on a monthly rate. Almost all of our members are annual because we have almost 50% off by going with the $997. During our fall special, $797, another $200 off. So if you like what we do, if you like our approach to the market and what I'm talking about, make sure you sign up. Go back to that homepage and at least At a minimum, make sure you sign up for the EB Digest and get that special stock. We'll send it out to you immediately. So you'll have that for Monday. If you're on your mobile device, you can use the QR code on your screen, and you can scan that, and that also will take you to the landing page to sign up for our EB Digest. I would encourage you. We have tens of thousands of folks that have signed up onto our EB Digest. It's a no-brainer. I mean, what you're seeing on this video, we teach over and over and over again. We give back to the community in hopes that some of you can afford our service and will sign up and support us in that fashion. But even just being here on YouTube and, liking our video, subscribing to our channel, that helps us as well. But anyway, have a great weekend, everybody. I think we're looking at a melt up in the market, and I hope you become part of it. Anyway, have a great weekend, and I'll see you next week. Happy trading.